Good morning, and today is Thursday, 6th of Feb 2014. We're looking at a trade setup on the pound dollar. Let's start off with a weekly chart, and this shows that we are in the end of a triangle in wave 4 on a larger degree, 1, 2, 3, and this triangle has stretched out for several years now already, from 2009 Jan to the present. So it's been a good 5 years for this triangle to have stretched out, and this is a wave 4 on larger degree, and we are expecting price to fall below wave 3 here at 135. So that's the broad framework we are working with, and the backdrop against which we are going to be trading on a short-term basis. Okay, so let's have a look at the daily chart now, and the daily chart shows a pretty clear momentum divergence on the MACD right from the wave W high at 162.56. Momentum has been steadily falling while price has been steadily making new highs. And what we have seen since the high here, let's just label that at 166.69. The move since then has been fairly impulsive, and let's look at we've drawn a trend channel based on Elliott guidelines, and price has broken the lower trend line, the lower upward sloping trend line, quite convincingly in an impulsive fashion, so which gives us reason to believe that the triangle correction on a multi-year degree is complete, and we should be looking lower at this stage. Okay, let's look at the 4-hour chart. So on the 4-hour chart, we see that wave 3 on a smaller degree has probably completed itself at 162.57, and we are looking for a wave 4 bounce towards the 163.98 to 164 level, 164.42 level. Now notice that wave 2 retraced 78%, almost 78%, so that's a fairly sharp correction. Wave 3 should typically retrace 38 to 50%, which is the guideline of alternation that Elliott talks about, and a trade then would be short in this particular zone right here. The stop loss could then go above this wave 1 low at 164.74. So the guideline, well, the rule says that wave 4 cannot enter the price territory of wave 1. Now this is based on the fact that we see 1, 2, 3, and then we expect a 4th wave and then a 5th wave lower. Now things could change, of course, if this is a 1, 2 and then another 1, 2 up, but trading would be difficult if we had to put our stops above this high here at 166.69. so go by the probabilities that this is a wave 3 down, and it's wave 3 is probably complete. The reason why we say that wave 3 is probably complete is if we look at the 1 hour chart for the wave 3. For wave 3 we see 8 in 9, we see wave 3 subdivided into 9 waves. 1, 2, 3, 4, 5, 6, 7, 8, and 9. Right, so that's the reason we feel that wave 3 is complete on a smaller degree, and we can expect a wave 4 bounce to this particular zone between 163.98 and 164.42, and the stop, protective stop, would go above 164.74 because wave 4 cannot enter the territory of wave 1, one of Elliott's most important rules. So the target would then be wave 1 is 194 pips, wave 3 is 368 pips, and when wave 3 is extended, then typically wave 1 has a relation to wave 5 of equality. So we can expect wave 5 to be approximately 190 pips. So wherever one figures that where wave 4 ends, this is just a very rough area. I've mentioned at 164.23. We could expect a wave 5 to go to about, in that case, it would be about 162.30 or so, which is a profit potential of approximately 190 pips, and one's protective stop would be above, say about 164.80, would be about 45 to 50 pips. So that's the trade setup that we see on the pound dollar for the 6th of February 2014.